Derivatives can seem confusing, but let's break them down. A derivative is like a side bet on something else. Imagine betting your friend that the price of gold will go up. That bet is a derivative because its value depends on what happens to the price of gold. Derivatives are used for a few reasons. One reason is hedging. Hedging is like buying insurance to protect yourself. Businesses use derivatives to protect themselves from price changes. For example, a company that uses lots of oil might use derivatives to protect themselves if oil prices go up. Another reason is speculation. Some people use derivatives to try and make a lot of money quickly. They're betting that the price of something will move in a way that benefits them. This is very risky. Finally, derivatives are used for arbitrage. Arbitrage means taking advantage of price differences. For example, if gold is cheaper in London than in New York, a trader could buy gold in London and sell it in New York to make money. Let's look at the key parts of a derivative. First, there's the underlying asset. This is the thing the derivative is based on. It could be a stock, a bond, or even the price of oil. Second, there's the notional amount. This is a number used to calculate the derivative's value, not the actual money involved. Third, we have settlement. This is when the derivative ends and people exchange money. The settlement date is the day this happens. Finally, derivatives don't need much money up front. This means you can control a lot of something for a little bit of money. There are many types of derivatives. We'll focus on the common ones. First, forward contracts. A forward contract is a private deal where one person agrees to buy and another agrees to sell something at a set price on a future date. Forwards are common when trading things like oil or wheat. Similar to forwards are futures contracts. Futures contracts are like standardized forwards, traded on an exchange. They also involve buying or selling something at a set price, but with specific rules. Options give someone the right but not the requirement to buy or sell something. This right costs money, called a premium. The price they can buy or sell at is called the strike price. The buyer chooses whether or not to use the option. Swaps are agreements to exchange cash flows. For example, with an interest rate swap, one person agrees to pay a fixed interest rate, and the other agrees to pay a floating or changing interest rate. Finally, we have embedded derivatives. These are derivatives hidden inside other contracts. For example, a convertible bond which can be changed into stock has an embedded derivative. IFRS 9 is a set of rules that tells companies how to record derivatives in their accounts. First, a derivative is recorded when the company enters the contract. It's recorded on the balance sheet at its fair value. Fair value is the price you'd get if you sold the derivative. Second, the derivative's value is checked at the start and regularly after that, always using fair value. Third, any changes in the derivative's fair value are recorded in the income statement. This means derivatives can affect a company's profits or losses. Finally, IFRS 9 has special rules for embedded derivatives. These sometimes need to be separated from the main contract if their risks are different. Hedge accounting is complicated. It lets companies make their earnings look less bumpy. This is done by matching the accounting for the derivative with the accounting for the thing being hedged. There are three types of hedges. A fair value hedge protects against changes in the value of an asset or liability. For example, protecting the value of a bond. A cash flow hedge protects against changes in future cash flows. Think of a company selling products in another country and protecting themselves if the exchange rate changes. Finally, a net investment hedge protects the value of an investment in a foreign business, like a company protecting their investment in a subsidiary in another country. IFRS 7 is another set of rules. It requires companies to tell everyone about their derivatives. This helps investors and lenders understand the risks. Companies must disclose what kinds of derivatives they use and why. For example, a company might say they use derivatives to protect themselves from interest rate changes. They also have to show how much they gained or lost on derivatives, how they calculate the fair value, and details about their hedge accounting. Derivatives can be complicated. Figuring out their value is tough and needs special knowledge and computer models. This can make it hard for companies to account for them correctly. Derivatives are risky. Their value can change quickly, leading to big losses. Companies using derivatives need to understand these risks and have good risk management. Also, regulations change, so companies need to stay updated. Understanding derivatives is crucial for ACCA SBR students. You'll need to know how to apply IFRS 9 and IFRS 7. You'll also need to spot and understand the risks of derivatives. The ACCA SBR exam will test you on all of this, so you need to know the different types of derivatives, how they're accounted for, and their risks. Derivatives can be complex, but by understanding the basics, you can start to see how they work and how they're accounted for. This is key for anyone working in finance or accounting.